In this video, I'm going to be showing you guys how I trade stocks profitably and pretty much the entire strategy that I use to trade stocks. It took me a long time to get good at it, so hopefully this video will give you a little bit of value so you can apply it to your own trading. So basically the strategy I use is called relative strength and relative weakness. RS and RW is a way for us to identify institutional trading and follow it. So to first understand why this strategy works, you need to understand that institutions move markets and not retail traders. Institutions make up 80% of all the volume in a given day, and they act in unison. They are directed by some of the most talented people on the planet. It's basically a big club that we're not in. If you compare that to retail traders, retail does not have very much money and they act in a disorganized fashion. Like even if you had $200 million and you wanted to make an institution, you would still barely qualify and you would be a very small institution. So by trading RS and RW, we are simply following the money. Relative strength at its core is basically just a stock that's outperforming the market. Here I have a few examples that hopefully explain this a little bit better. Here we have the SPY on the left and a stock that is outperforming the market on the right. Even though both of these gapped up, you can see that the market did stack a few green candles, but it very quickly started to test the opening of the overnight gap. But the stock was able to preserve the entire gap and stay above VWAP for pretty much the entire day. And it's pretty clear that a trader would have a much better time trading this stock over the market. This is a textbook example of relative strength. And on the flip side, we have an example of relative weakness here. While the market was doing pretty much nothing here and just chopping around, the stock here has a pretty clear trend. Both of these gapped up, but the stock instantly started to produce red candles. And while the market was just dancing around VWAP in a range, the stock was able to stay under VWAP for pretty much the entire day. So this is a pretty clear example of relative weakness. While the market was just doing nothing, the stock here is clearly underperforming the market, and a trader would have a much better time trying to trade this over this. So that's pretty much what RS and RW is. Instead of trading the market itself, we are going to trade stocks that have a clear trend driven by institutional trading. Like when you see a stock that has movement like this, it is caused by one thing and one thing only, and that is institutional trading. So to be profitable, you have to identify what the institutions are trading and follow it. And relative strength is the primary way of doing this. But there's something that you can't ever forget when trading stocks, and that is market first. When we trade stocks, we are essentially trading the market itself, but we're using stocks to increase our win rates and profit factor. We do not go short when the market is bullish and vice versa. So now that I've explained what the strategy is, let's go over some trade recaps of this strategy in action. So here's a trade that I took a few days ago when we had a bearish trend day. When the day started, we had a gap down. The market did stack a few green candles, but half of the gap was preserved. The market stalled at the halfway point for a while and eventually crossed below VWAP. So at this point, I wanted to try a short on a bearish stock. And in my watch list, I had DECK. The stock has been showing relative weakness. If we compare it to the movement of the market, we can see that the market was pretty flat here, but the stock was dropping. So I went short on the stock, expecting the market to have a little bit of follow through and make a new low of day. Obviously that didn't pan out like I expected, but since I shorted a weak stock, everything was fine and the trade started to perform instantly. And the market did eventually make a new low of day, and I just rode the stock for pretty much most of the day. I don't use static take profit levels like a lot of traders do. I only exit trades when the chart tells me to or when the stock hits my hard stop. In this case, my hard stop was just above VWAP, right around here. I also don't panic and exit trades just because we see a few green candles. It is perfectly fine when the stock bounces when you're short. You just want to make sure that the bounce is brief and shallow, and it gets taken out pretty quickly. If this bounce were to develop into like some deep bounce all the way up to VWAP, then yes, I would have exited the trade. There's no need to exit the trade just because of a few green candles. It's actually what happens after the few green candles that's most important. As you see, we did have a few green candles here, but right after we had a bearish engulfing candle. It told me that I should stay in the trade. So yeah, weathering bounces is fine as long as they are brief and shallow, but I did end up exiting the trade right around here, mostly because the stock has been showing signs of bottoming out for the past few hours at this point. It's basically been flat if you compare it to the price action earlier. The stock did not respond at all to the red candles that the market produced here, and the day was pretty much over. So I exited the trade. I did not want to take this trade as a swing, and that's pretty much it. For our next example, we have a trade that I took a few months ago. I have it stored in my trading journal, so I figured I would show it. So on the left, we have a stock with the ticker PL, and on the right, we have the SP500. You can see that the market this day was pretty much just floating higher. The trend isn't particularly strong like you would see in a quality bullish trend day, we had mixed overlapping candles, and later in the day the market kind of just started chopping around. So if I wanted to trade the market futures directly, I probably wouldn't have had a good time, but that is where PL comes in. As you see, we have a nice orderly trend higher. We end up having a dip that does not reach VWAP. Then we have a nice rebound to a new high of day with orderly price action. So when the stock dipped again, I ended up buying on this candle when the stock made a higher low. But because the market price action wasn't playing out like I expected, I ended up selling just a few candles later. I expected the market to be a little bit more bullish, but that ended up not happening, so I just exited the trade a few bars later. Now for our last example, we have a bullish trade that I took a few days ago. On the left we have SPY, and on the right we have SATS. When it comes to the market, I did have a bullish bias for the day, at least at the start, because we were able to preserve half of the gap. The market gapped up, it instantly started to probe for support, and it did eventually find support at the halfway point of this gap. And when the market preserves at least half of the gap up, that is a bullish indicator in my experience. So since I was bullish on the market, I wanted to try a long on a strong stop, and I ended up finding SATS. It did gap up with the market and was able to stack green candles while the market was stacking reds. It ended up kind of succumbing to the market here by printing a few red candles, but it was still able to preserve VWAP while the market was below VWAP. And it was kind of a bummer because the market looked more bullish than it actually was. Like when I entered the trade, the market was in the midst of this green candle right here. Looked like we had a long green candle that just slashed through VWAP. And now the market was going to head to a new high of day. But obviously that didn't happen. Right when I took the trade, the market went all the way back down to VWAP. I ended up sticking with the trade because the market just isn't bearish enough to get me to exit the trade I just took. Obviously the market did end up breaking down and it made a new low of day, even though I was bullish on the market and I thought the market would go and make a new high of day. So yeah, obviously I was wrong on the market, but that is the beauty of trading RS and RW. Even though the market broke down pretty hard here, the stock was able to preserve VWAP and allow me to exit the trade for a scratch. If you don't know what a scratch is, it's basically a trade that ends in no gain or loss. So yeah, even though I was wrong, it still worked out pretty decent in the end. At least I didn't, have a loss. And you can imagine what would have happened if I trade the futures directly. Would have bought here on this giant green candle. I would have taken a big fat loss right in here. So yeah, this is why RS and RW is so good. You're able to limit your losses and exacerbate your gains by trading stocks that are either outperforming or underperforming the market instead of the futures itself. Now, I used to trade futures, but I noticed that it's a lot easier to make money when I'm trading stocks. And yeah, this is the end of the video. I hope this video brought value to someone. This is the first video on my channel, and I expect to make many more. So I will see you guys in the next video.